All right, welcome everybody. Looks like we're at the top of the hour. Let's get started with our webinar today. Welcome to Navigating Not-for-Profit Accounting, Audit, and Tax Changes, key updates for your organization. Thank you for joining us today. I'm Jill, and I lead the not-for-profit tax practice here at Sikich. And I'm part of a larger team who specializes in the not-for-profit industry. We host webinars several times a year on topics that are pertinent to this industry. If it's your first time joining us, welcome. Sikich is a professional services firm supporting not-for-profit organizations through our audit, tax, accounting, advisory, and technology solutions. Our team serves a variety of not-for-profit organizations, including higher education institutions, social service agencies, healthcare, foundations, associations, and more. We have team members really across the United States, and we enjoy being able to connect with you all virtually today. So for today's agenda, we're going to cover changes to CFR 200, Uniform Principal Requirements, Audit Requirements for Federal Awards, Credit Loss Standards, CECL updates, Employee Retention Credit updates, and a little information on energy credits. Before we begin the discussion, I have some brief housekeeping items. I encourage you all to use the questions feature. Our marketing team will be monitoring for those questions, and we hope to have time at the end to cover a few of those. If your questions aren't answered during the presentation, we will follow up after the webinar. The slides for today are available to download in the handouts section at the top. And today's session does qualify for CPE credits. So you will have 3 polling questions that will launch throughout the webinar. Those do need to be answered in order to receive credit for attending the presentation. At the conclusion of the webinar, there is a short survey that will launch, and you will also need to complete that evaluation for CPE credit. The certificates for that will be emailed after the program within 2 weeks. Okay, I'm happy to introduce my Sikich colleagues and fellow not-for-profit team leaders, Lauren Groff, Jennifer Kasakia, and Kelly Fedkenhauer. They all have years of experience working alongside our not-for-profit organizations. I will have them introduce themselves at the beginning of each of their presentations. So I'm going to turn it over to Lauren now to get us started.
Great. Thank you, Jill.
But first we have a poll question, actually.
Perfect.
Okay, so we have very easy polling questions for you all today. We don't want to add any additional thoughts needed for your lunch hour. So if you can just answer this again, please, that will allow us to offer a CPE credit for this session.
Great. Well, welcome again, everyone, and thank you for spending your lunch hour with us. My name is Lauren Groff. I'm a principal here at Sikich, and I lead our audit assurance service line for our not-for-profit industry. So really excited to be able to share some pertinent updates that are affecting our not-for-profit organizations as we speak. First, I'm going to be talking on changes to the uniform guidance. There was a new compliance supplement that came out in April. Our 2024 compliance supplement actually issued in early May. And then it is effective for years ending May 31st, 2024 and later. So those organizations having a May 31st, 2024 and forward year end, if you're currently in the midst of your undergoing your annual audit, you'll be following this new 2024 compliance supplement. Just a few highlights to this supplement. Looking at a couple of things here, we do have one of our continuing ALN numbers, our programs that we've seen evolve during the COVID pandemic. A lot of nonprofit organizations and others did receive the coronavirus recovery funds. This does continue to be considered a high-risk program under OMB's guidance. So meaning that it is required to be selected for detailed testing by the auditors each year. There are a few additional uses of the funds that were included in the new compliance supplement, able to provide emergency relief from natural disasters or negative economic impacts of natural disasters. So a new use added there. And then also a few other new uses of this grant funding. Funding projects that are eligible under certain programs administered by the U.S. Department of Transportation, and then funding projects eligible under Title I of the Housing and Community Development Act. So not a whole lot of changes, just these few new uses. So for some organizations that this may fall applicable to, just a couple of new points there. The other area of the compliance supplement that saw some new new guidance deals with the student financial aid cluster. So any of our organizations any organizations receiving those funds, there were some revisions to requirements for how auditors are going to be testing cash management and reporting aspects of that program. And then probably one of the most significant changes relating to higher education institutions that do report to the Department of Education for their compliance audit is the requirement to further identify all related party transactions and report some required elements of those transactions within a footnote to those financial statements. So really adding increased transparency and disclosure regarding an institution's any and all of their related party transactions. So that was really the update on the actual kind of changes that are affecting the 2024 audits that many of you may be in the midst of. I wanted to spend the majority of our time today going through the changes within the uniform guidance that are really going to be becoming effective here, starting with year ends coming up this fall. Some things that organizations need to do to be prepared is to read through the new supplement, be familiar with the changes. Change management will be critical to recipients to understand the nuances of the changes and make sure that all of their policies and procedures are in compliance with the new guidance. So notably, we'll go through this. This is not going to include all changes, but just some of the more notable ones that we wanted to make you aware of today. Within the guidance, subparts A through E, the OMB did replace the use of a non-federal entity, was replaced with recipient or subrecipient. So very minor change, but you may see that just wording definitional change throughout. Then when we move into subpart A, there are some updates to the acronyms and definitions. We'll go ahead and advance the slide. So looking at the requirement to capitalize equipment purchased with grant funds, that capitalization threshold had typically been $5,000. That has been increased to $10,000. So a welcome increase there as the cost of equipment continues to rise. Also, the definition of question cost was updated to clarify and provide examples of what a question cost is or is not, but did not significantly change that from a policy perspective, just gave some additional guidance. Moving to the next slide, looking at subpart D, post-federal award requirements for organizations. So looking at internal controls. That added a requirement that a recipient or subrecipient take reasonable cybersecurity and other measures to safeguard personally protected identifiable information. So really kind of catching up with the environment that we're in ensuring that the information is protected. So the OMB didn't provide any specific framework for organizations on how they would like to see this documented from a policy perspective, hoping that we'll get some more specific guidance on this topic in the future, but do know that it is one of the more significant changes and additions that you will see going forward. Looking at subpart E, section 200, 313, equipment. So again, increase that capitalization threshold from 5,000 to 10,000 to track. So a welcome change there. Looking at procurement methods, there was small changes in some terminology there. The OMB changed the definition of small purchases to simplified acquisitions, and then also clarified that micro purchases and simplified acquisitions are types of informal procurement methods for small purchases that are allowable under the guidance. So slight revisions include as well that the recipient or subrecipient may exercise judgment in determining what number is adequate in terms of the number of rates or quotes that they get when they are procuring a simplified acquisition or a micro purchase. Looking at subrecipient and contractor determinations. So just a few subtle things here. This is really going to be applicable to organizations making subgrants. Really need to look at all of the factors and the substance of the agreement and the activities and duties, characteristics of each agreement when making this determination. Clarification was added that no single factor or combination of factors contained in the section is necessarily determinative of whether the agreement is a subrecipient agreement or a contractor relationship. Emphasis was noted on the need for the pass-through entity to exercise judgment, again, in classifying the type of agreement that this is, to make sure that you have the proper agreements and documentation in place, as they do vary very differently whether or not you are truly passing on grant funds to a subrecipient or if you have a vendor contractor relationship. Looking at indirect cost, the increase in the de minimis rate prior to the new guidance was 10%. They have increased that up to 15%. So again, another welcome change as costs continue to rise, allowing organizations that do not have a federally approved indirect cost rate to go ahead and use up to 15%. There was clarification that a recipient or subrecipient may notify the OMB of any disputes with a federal agency regarding the application of a federally negotiated indirect cost rate. However, OMB did clarify that they will not formally arbitrate or assist in those disputes. So just an interesting piece of information that was added to this section. However, the welcome change is that instead of a limit of 10%, this is up to 15% now. And it does have to be of actual cost, so it may go up, not to exceed actual indirect cost. Required certifications. This was another interesting addition here. The OMB did add a requirement for subrecipients to certify to the pass-through entity whenever they are accepting funds, requesting payment of funds, or submitting reports, that they certify the information is true and correct and accurate. Kind of see the full language here. This does apply to all tiers of subrecipients. So for those of you receiving grants as a subrecipient, you'll want to work with your granting agency or organization on this. So then most notably, moving into audit requirements. So this one is going to be a change, for some, a welcome change. Audit requirements were revised and are effective for fiscal years beginning on or after October 1st of 2024. So these are going to be fiscal year ends. September 30, 2025 will kind of be the first fiscal year end that this new audit requirement thresholds apply to. So September 30, 2025 and after. So unfortunately, not this upcoming audit period. If you're currently in the midst of your audit or you have a September 30 year end and you're kind of gearing up for that. These new requirements do start with years beginning after October 1st, 2024. The notable change here is that the increase to the audit threshold requires organizations expending more than $1 million now in federal awards to be subject to that single audit. So previously that threshold had been $750,000. So now will eliminate some burden from some smaller, some organizations that have smaller federal award programs may no longer be subject to a single audit. You do have to expend more than $1 million now. There is no early adoption of the threshold though. So if you're kind of between that 750,000 and $1 million for 2024 period, the threshold is 750,000. So that does not increase and no early adoption permitted. A few things on the report submission. As far as the guidance does now allow the cognizant agency for audit or the oversight agency for the audit to authorize an extension when the 9-month time frame would place an undue burden on the auditee. Previously, there really were not extensions provided when it came to the 9-month deadline, and that was solely the responsibility of OMB in the past. So interesting update and revision on this area. Looking a few more things on audit requirements, standards and scope of the audit. There was an update to reflect that the schedule of expenditures of federal awards may be prepared in accordance with GAAP or an other comprehensive basis of accounting. So most times the schedule is always provided on the GAAP basis. However, this does allow another basis of reporting. And then a statement related to the requirement for compliance testing. Specifically called out the need for auditors to include test of transactions or other auditing procedures necessary to support the audit opinion on compliance. So really performing some detail testing on the audit side or level of audit. Looking at audit reporting, just one subtle change here. When the amount of known question cost is not determinable or it's unknown, a description of why the dollar amount was undetermined must be reported as part of that finding. And then finally, to wrap up, just a couple of things on the major program determination. With the increased threshold for uniform guidance audits to be performed, the requirement for what auditors consider a type A program, which does require detailed testing in the audit, that has increased to $1 million. Previously, that threshold was $750,000 as well. And then finally, what do recipients of federal funds need to do now? Really review the new guidance, understanding the breadth of the changes and the impact that it will have on your existing policies and procedures. So ensuring that you do review which portions of the new guidance is applicable, where your current policies and procedures sit, and then updating those. In many sections of this new uniform guidance, it does state that a recipient must have written or documented policies and procedures that address a specific requirement. So really starting now to evaluate and determine a process for anything that does need to be updated or changed by the organization. All right. Our second keyword poll, if everyone can take a few moments to answer this poll, and then I'm going to turn the next portion of the presentation over to Jennifer to talk about credit losses.
All right, thank you, Lauren. My name is Jennifer Kasakia. I'm a director here at Sikich, and I am on the audit side along with Lauren. And today I would like to talk to you about the current expected credit loss standard, or CECL, under FASB's Accounting Standard Update 2016-13. And this is codified in topic 326 if you're looking for the references today. Next slide, please. The highlights of CECL, when we're talking about current expected credit losses, you may be familiar with the term allowance for doubtful accounts. This standard expands upon that. We're not just talking about the allowance for doubtful accounts on accounts receivable per se, but we're talking about an allowance for credit losses on financial assets that are measured at amortized cost that fall within the scope of CECL. And when we're talking about expected credit losses, current GAAP requires waiting until it's probable that a loss has been incurred in order to recognize that loss. The new guidance will require forward-looking estimates on day one that the financial asset is originated, and that estimate of expected credit losses will need to cover the entire contractual term of the applicable financial asset. This is effective for 2023 calendar year ends and fiscal 2024 year ends. So several of our clients are now implementing the standard, or perhaps you're still preparing and need to know a little bit more about how CECL is going to impact your organization, so you're in the right place. In terms of implementation, this will require a modified retrospective approach. Next slide, please. This chart just compares and contrasts current GAAP with the new credit loss standard in 4 major areas. In terms of recognition is going to occur. You're going to have to record an estimated credit loss even if the risk is remote. So it removes that probable threshold, or when the loss is incurred. So we're expanding or lowering the bar on the recognition threshold. The unit of account is slightly different. Under CECL, you are required to pool financial assets at amortized cost into groups to measure expected credit losses when they share similar risk characteristics. Under legacy GAAP, pooling was permitted but was not required. In terms of economic conditions, the CECL standard requires management to consider both current economic conditions and management's expectation of future economic conditions. And I'll talk a little bit about the limitations of that in a minute. And then in terms of the evaluation period over which management needs to estimate credit losses, you will now be able to measure, or be required to measure, expected credit losses over the entire term of the asset's life. And in legacy GAAP, the term over which you would have to estimate the allowance for credit losses wasn't explicitly considered. Next slide. So who and what is affected? CECL applies to all entities, and that would include not-for-profit organizations. And it applies to financial assets that are measured at amortized cost basis. So assets that may be within the scope of CECL would be your trade accounts receivable, or your program service fees receivable, notes receivable, net investments in leases recognized by a lessor under Topic 842, held to maturity debt securities, including certificates of deposit. And I want to make a distinction here because this standard only applies to assets at amortized cost. So if a not-for-profit organization holds a certificate of deposit directly with a bank and is recording that at amortized cost, it is within the scope of CECL. Whereas if a not-for-profit organization has certificates of deposit in their investment portfolio, a brokered account that's traded and is recorded at fair value, those types of certificates of deposit at fair value are not within the scope of CECL. So just a little distinction there. It also applies to reinsurance recoverables, off-balance sheet credit exposures such as guarantees or loan commitments, and programmatic loans. Next slide. Not-for-profits do get a big break here. Financial assets that are measured at fair value, such as those brokered certificates of deposit or other investments at fair value, are scoped out, so there's no allowance for credit losses on those. Promises to give, or pledges receivable, contributions receivable, however you term those transactions, those promises to give are not within the scope of CECL. However, you still may need an allowance for doubtful accounts if there is some question on collectability. These just have a different measurement focus than assets within the scope of CECL. Also scoped out are loans and receivables between entities under common control, receivables arising from operating leases under Topic 842, and loans issued under defined contribution employee benefit plans. Next slide. All right, so the main provisions of CECL are we're going to measure expected credit losses against the financial assets that are required to be held at amortized cost, and we're going to present that in the statement of financial position net. So the allowance for credit losses will be disclosed on the face of the statement of financial position. And then any change in the expected credit loss is going to flow through the statement of activities in the change in net assets. So similar to how changes in the allowance for doubtful accounts are currently presented, that change in the expected credit loss also falls out in the statement of activities through the change in net assets. The measurement of expected credit losses will have three components: historical experience, current conditions, and reasonable and supportable forecasts. And I'll break those down in the next slide. So in terms of historical losses, typically an organization will start with their actual historic loss information. So this doesn't necessarily need to change under current GAAP. What you're doing now, you can still start with that base of historical loss information. CECL does not specify a particular approach that you need to use. However, you want to make sure that you're comparing apples with apples. So if you're trying to evaluate a pool under CECL, you'll want to make sure the pool you're evaluating, the historic loss information that you're pulling is for the same nature of the same pool of assets. So you're able to use that historic loss information to make judgments and estimates about the same similar pool of assets going forward. You don't have to use the most recent historic loss information if a prior period gives you better information. So let's say the immediate previous year was an outlier and you want to go back 2 years to develop your historic loss information. That's perfectly acceptable. Next slide. This is right from the codification. It says this is the rationale for our new way of estimating, because historical experience may not fully reflect expectations about the future. Management needs to not only consider historical information, but that needs to be adjusted by current conditions and reasonable and supportable forecasts. So in making the determination, management needs to decide what current conditions, what reasonable and supportable forecasts, what information do they need to consider that is relevant to determining the expected collectability. Next slide. So how can they do this? The first way they may do this is by looking at the current expected credit losses in asset-specific ways. So for instance, your trade accounts receivable, you're probably going to look at estimated forecasts differently than you would look at your notes receivable or your certificates of deposit. There's probably going to be some asset-specific approaches that you want to try and implement when you're looking at CECL. You also may want to further break that down into customer-specific categories, because if you have similar risk characteristics, you're required to pool them or use a portfolio approach. But to the extent that you have certain customers that may be outliers or not share similar risk characteristics, you may need to get down to a customer-specific level. You want to make sure that your allowance calculation is related to the expected economic conditions that go along with that particular asset. So there's going to be significant judgment required in developing these estimates. Next slide. So one of the things to consider is that in preparing current economic conditions and reasonable supportable forecasts, You may consider internal information to the organization, external information, or both. So you need to consider the organization's environment, factors that are specific to the borrower, and prepayments. So as an example, if management is trying to estimate the allowance for credit losses on tuition receivable, they may consider factors such as graduation rates, job placement rates, and unemployment rates as metrics that may go into their supportable forecast going forward, because they relate specifically to what the expectation is that the students will be able to repay their tuition receivable. For instance, if they don't graduate, they might be less willing to pay that outstanding receivable, or if they don't get a job after they graduate, they won't have the means to pay that receivable. So you just want to make sure that the factors that you're using to make those forecasts relate back to the asset that you're trying to measure. Next slide. So CECL does not specify any particular estimation approach. So management may use any number of these estimation approaches depending on the financial asset that they're trying to measure. So I won't go through each one of these. They're here for you in the slide if you'd like to take a further look at that. And as a reminder, you're not required to change the estimation approach that you're currently using. You just need to take that estimation approach and layer on current economic conditions and reasonable and supportable forecasts to that historical information, because the historical information alone will not be enough. Okay, next slide. So a question that's commonly asked is, can you have zero expected credit losses? Under CECL, you're required to estimate recorded losses at inception, even if that risk of loss is remote. So in order to have zero credit losses, it's a really high bar. You really want to make sure that you've documented why you assert that there's zero expected credit losses over the lifetime of that financial asset. And some examples might be if the not-for-profit organization has a government receivable, the amount has already been appropriated by the government. All that's waiting, the not-for-profit has already performed its obligation under the agreement, and all that's waiting is collection of payment. So it's a pretty high bar in order to have zero credit losses. The other example would be in Treasury securities or certificates of deposit that are fully insured by the bank. All right, next slide. In terms of transition, you're going to use a modified retrospective approach, and there are transition disclosures that are required. You're going to present that group of financial assets measured at amortized cost net of the allowance for credit losses, and disclose information that will help users understand how the credit losses were estimated. Next slide. And I've thrown in a couple of disclosure examples just so you can see the level of detail that will be required. And I'm not going to read them word for word. They're here in your handout. So if you want to go to the next slide, this was one on AR. And then the next slide, I believe, has one on the quantitative information, the roll forward of the allowance for doubtful accounts that's required. And then this is a disclosure example if you had certificates of deposit that were fully insured by FDIC. If you had, let's say, certificates of deposit that aren't fully insured, then you probably need to go into more detail about why zero credit loss is expected. For instance, the credit strength of the bank that's issuing the certificate of deposit and so forth. And then next slide. I think that concludes my section of the presentation, and I'm going to turn it over to Kelly. Thank you.
Thank you, Jennifer. Good afternoon, everybody. My name is Kelly Fetkenhauer. I am a principal in Sikich's Forensic and Valuation Services Group. Today, I will be transitioning us from the audit side to the tax credit side. I will talk about the employee retention credit that I'm sure we're all aware of and have been hearing a lot about in the news, just to give you an update on where we're at, a little bit of background about the program, and then things that people and entities should be thinking about who have applied for and or have already received their ERC credit. And then Jill will continue on energy credits. Next slide. Okay, so I'm just going to get a high-level overview of the background of the ERC program. I'm sure most of us are already familiar with it, may have even applied and received an ERC credit. But as you know, or maybe
Hey,
don't know,
hey Kelly, can you hear me?
yes.
So there's a ringing sound that I'm getting from, I think, your speakers. Do you maybe have a different audio or headphones or something? Or maybe turn up your volume?
I don't have a different audio. Is that better if I just sit closer to the computer?
Yeah, that actually sounds better to me.
Okay. I have a little bit of an echo in my room, I think, is probably the problem. So just let me know if you can't hear me in a few minutes.
Will do. Thanks, Kelly.
Okay, sure. So the ERC program was created by the federal government to assist employers during the COVID pandemic. As we all recall, there was a lot of panic back in 2020 when COVID hit. A lot of employers didn't know if they were going to be able to make payroll as a result of the pandemic, businesses being shut down, services being interrupted. So this program was initiated to incentivize employers to keep employees on payroll. So as I mentioned, it did come out in March 2020 through the CARES Act, and it was meant to do just that, of keeping employees on the payroll. In 2020, if you applied for an ERC credit, you could get up to $5,000 per eligible employee for the year. In 2021, that amount did increase to a quarterly amount up to $7,000 per eligible employee. The credit itself was determined on a few different factors. You would be eligible as an employer if you met either the gross receipts test, which meant that there was a decline in your financials and your revenue from 2019 as a result of COVID, or if your business was impacted by a government shutdown. So there were a lot of government orders out there during this period of time, and that would impact businesses either fully shut down or a partial shutdown. So this program was there for employers that were impacted by COVID. And now we're hearing a lot in the news about this particular program. Obviously, COVID was an emergency situation. The funding was pushed out by the government quickly to help employers. But as a result of that, sometimes money goes out quickly without being able to do a full audit of each claim that comes in. So now we're seeing that the IRS is doing audits, is disallowing some outstanding ERC claims that haven't been paid yet. And there's just a lot of news and issues around this program. So I'm going to talk about those issues today, and then we're going to go into what entities should be thinking about who have applied for an ERC claim, if they've received the money, or even if they haven't received the money, what they should be thinking about and considering, and how Sikich as a firm could help those entities. So next slide. Okay, so in the news, we have been learning that the IRS, while they had been quiet for a bit with releasing and paying out ERC credits, they are now starting to pay those out. But as part of that, they are disallowing ERC applications. So recently, there was an article, lots of news about IRS having disallowance letters sent out to high risk entities that had applied for the ERC credit. So there was 28,000 at the point of time when these slides were created, 28,000 disallowance letters sent out, and about $5 billion worth of ERC claims that were disallowed. And they have noted that about 30,000 more letters will be going out. So they'll be disallowing approximately 30,000 more ERC claims. In addition to disallowing, they are doing audits and investigations, including criminal investigations. So at this point, there have been approximately 460 criminal investigations related to entities preparing false claims to the government. A lot of the audits that are going on are related to high risk entities, high-risk claims. And you can go to the next slide. And those claims that have been determined high risk, and I'll talk about the buckets that they have identified in the categories. The ones that are high risk are based on multiple factors, but a lot of the big ones are entities that used a promoter. A promoter is a firm that came out to entities and said, there was a government order that impacted your business, therefore you're eligible. Here's a way that you can apply for this funding, this program, and didn't necessarily do a thorough review to determine if that entity met the eligibility requirements. So I'm sure you've heard about some of the promoters in the news. So that is a high risk of the IRS. If they determine that a promoter was used, they're going to look into that ERC application a little bit higher, or more likely, because it's a higher risk claim. Other ones are for entities that may have applied for multiple ERC applications. Also, another one is misrepresenting that an entity was impacted by a government shutdown. So there may have been a government shutdown that was in an area that that entity worked in, but maybe that entity was able to work virtually. So their business wasn't actually impacted. So those are some of the high risk factors that the IRS is looking at and has determined. But here, like I mentioned before, there are 460 criminal investigations that are going on. Any program you're going to see people doing the wrong thing, right? So there's always going to be bad actors, but there's also going to be entities that may just not have a supportable file to support that they were eligible. So we'll talk about some things that entities who have applied for the ERC credit can be doing proactively to make sure that their file is supported to support their claim that was submitted. So the IRS has reviewed over 1 million ERC claims, which amounts to $86 billion. So that is a lot of federal funds and taxpayer dollars that have gone out or have been applied for through these entities through the ERC program. So it's a lot of money that we're talking about. And the IRS is now really scrutinizing those claims. So recently they have released the reviews that they're doing, and they have categorized the ERC claims that are outstanding into 3 main buckets. The first bucket is what they have identified as likely, improper, or fraudulent, and they are identifying that amount to be about 10 to 20% of the ERC claims that are outstanding. And these will be denied by the IRS because there are clear indicators of fraud or other non-compliance with the program eligibility requirements. The next bucket and the bulk of the claims is 60 to 70%, which they have identified as very questionable. So these are claims that the IRS will do further analysis on. They'll likely reach out to the entities through a letter requesting additional information to be able to determine if the eligibility requirements were met and if that is an eligible claim that should be paid out. Then the last bucket is lower risk ERC claims, which is about 10 to 20%. And these appear to comply with the guidelines, don't look to be fraudulent in any way or non-compliant. So these are ones that the IRS will continue to process and get the money out to individuals sooner, hopefully, rather than later. Next slide. Okay, so if anyone out there has applied for an ERC claim and hasn't been paid, I'm sure you're aware that there was a real stalemate in IRS processing these claims. There was a long period of time where money just wasn't going out, and that was because of a moratorium. That has ended, and they are starting to process these claims again. Again, that is why they are also doing their additional work of trying to determine, is this high risk, is it medium risk, is it low risk? For those ones that are just questionable or medium risk, they're going to be asking for additional information from those entities or taxpayers, and we'll hopefully be able to process those when additional information is received. One thing to note, if you do get one of those notices in the mail, they can have a pretty quick turnaround. So again, being proactive to try to get your files in a document in a place that you can easily go to when the IRS does send you that letter, so you're ready to provide that information and don't have to scramble at the last minute, because we all know those notices do seem to always come at our busiest time. So you want to be proactive and try to get all your ducks in a row ahead of time. There also was a new update. I'm sure some of you are familiar that there was a first voluntary disclosure program that ended back in March of this year. They did open up a new one. So just recently they announced a second voluntary disclosure program where entities who have applied for an ERC credit can withdraw that claim. So that is open until November 22nd of this year. So if an entity does feel that they may not have been eligible or now with more information don't believe that they should have applied for the claim or the amount should be different, they do have the opportunity to join into this voluntary disclosure program. And again, that period of time ends November 22nd, 2024. So what's next for taxpayers? Some people are still waiting for their claims to be paid. Some are just nervous about all the news that's out there and thinking about, okay, what should I do? Should I go back and review what was submitted? Do I need to get documentation in line? How do I prepare for the IRS? So what I would recommend is get someone to assist you with gathering up all the documentation that supports your eligibility. So if you use the gross receipts test, to show that you had a decline in revenues, have your income statement or your profit and loss statement that supports that in a file that's ready to go, the analysis there, and it's all supported in case you're asked. For the government order shutdown, that can be a little bit more subjective, and you would want to have all of your eligibility requirements, how those government orders impacted you, which ones, how your business was impacted. You do have to prove that more than nominal amount of your business was impacted by a government shutdown. The whole business doesn't have to be shut down. A partial amount can be shut down and you would still maybe have a nominal impact on your business. So you want to have documentation to show how you were impacted to support that in case the IRS has come asking for additional information. Next slide. Oh, I think there's a keyword pull and then next slide.
The note here, we will add an additional poll question at the end for those of you who may have missed the first one, and you only need 3 to get CPE. So again, watch, we will do one more here at the end.
Okay, so next I'm just going to quickly go through some compliance tips for anyone who does have an ERC claim that they've either submitted or ERC amount that they've received from the government. So go back and evaluate your ERC claim thoroughly. Sikich is here. Like I said, I am in our forensic group, but my background is in claims support. So I have a large background in preparing claims against and for owners. So in this situation, obviously it's a claim that was submitted to the government. I do a lot of work for the government, so I know the type of documentation that they're looking for to support claims that are being requested as an amount that's owed to an entity. So you want to make sure that you met the eligibility requirements. Was it the gross receipts test or was it the government shutdown test that made you eligible? Making sure you have all of your data together and being ready in case you ever do get a letter from the IRS that says we're selecting you for an audit or we need more information. Because like I said, those turnarounds can be pretty short and you want to be able to have that information available to send on to validate and support your claim. So like I said, prepare for audits. We can also assist you with that as well. So we can come in and help look at your claim, make sure the eligibility requirements were met, but document all of that and get a file together for you. Obviously, you have 9 to 5 jobs where you have other things you're worrying about. So if you need some assistance with preparing that file to support your ERC application, that is something we could help you with at Sikich. Also, the voluntary disclosure, this is the second program that has come out. If you were thinking about doing the first one but missed it, now's your opportunity. Or if you're just thinking about your ERC application and just want a second opinion to make sure that there is no issues with what was done. If it's determined that there was an issue or you didn't meet the eligibility requirements, now's the chance to be able to withdraw that claim. And it does allow you to pay just 85% of whatever amount you received from this program. And then lastly, stay proactive. As I mentioned, you want to get ahead of this. If you have any concerns about, your ERC claim, maybe you're eligible, but you don't have all the documentation in a folder somewhere, gather all that now, get it together. Or if you want someone to take a second look to make sure that all the eligibility requirements were met, the calculation was done properly, do that now before you get that notice in the mail from the IRS, because those things do move quick and you'd rather be proactive than reactive. And last slide. And as I mentioned, we're here to help. We can assist with determining if the eligibility requirements are met. The gross receipts test, obviously we can check the numbers to make sure that there was a decline from your 2019 revenues. For the government shutdown test, we'll determine were the government orders that were identified applicable in your area, how was your business impacted, get that story from you, get all the justification documentation in place, so we can obviously assist with the eligibility portion. Then we can look at the calculation just to ensure it was done properly. A lot of entities also received PPP loan money, and that's something that has to be accounted for in the calculation. It can't, you can't get the same dollar twice. So that's something that we could also assist with. Next slide. And then as I mentioned, be proactive. So that is something that Sikich could help with as well, pulling a file together, getting everything in one place that supports your eligibility, the calculation was done properly, and having all of your documentation supported and ready to go in case the IRS ever does come to look for additional information or perform an audit. So that is a high-level overview of the ERC program, the highlights of what's going on in the news regarding the program, and then how we as a firm can help anyone who has received an ERC payment or has an application outstanding. So now Jill is going to move on to energy credits.
Okay, so transitioning to there's not a lot of changes in the tax world occurring right now, but this is something I just wanted to make sure that we are getting in front of everyone. It's not terribly new, but this is kind of the first reporting year for these energy credits. And the reason I want to bring it up is really as it is really new. They're out there for the next probably 10 years or so for many of them. Just kind of starting to think, get this on your radar as an organization as you're thinking about strategic planning processes, as you're thinking about budgeting at your organizations. Make sure that these are on your radar if there's some sort of improvements or things that may qualify. So this is a really high level overview just to make sure that this is all on your radar. Perhaps you've seen there's been a lot of coverage here around these energy credits, but wanted to make sure it's on everyone's radar. So the energy credits are a result of the Inflation Reduction Act of 2022. So like I said, fairly new. And the biggest news here was that, tax exempt organizations and governments are eligible for these credits. And that isn't always the case when we have a lot of these credits out there. There's always a lot of question around that. These were very clear from the start that not-for-profit organizations are eligible entities to receive these. The also probably even bigger news item is that they call it elective pay eligible or direct pay eligible, meaning that you are able to get this credit directly. You don't need to have any tax due in order to get this credit, which is the case with a lot of other credits. So I think the tax exempt world just really needs to be aware of that this is out there and that this is not something you need to say, oh, we don't have any taxable income, I'd never be able to offset our tax. This really is just there's a direct pay option here. One of the things that's required is that you have to pre-register with the IRS in order to obtain a project number prior to filing for this credit. So it's one of those things, like I said, really keep on your future radar as you're thinking about some of these potential projects that you do need to pre-register for it. You can't just wait until the end and file a tax form and get the money back. So, and the important date here is that it's when the project or item is placed in service is then when you would go to obtain that registration. And then it's claimed on a Form 990T. So again, there's a lot of organizations eligible for this. I know we've had some of our local government clients that have been able to take advantage of this that we're working through currently. and they don't typically file a tax return. So this is something new for them, but they can just file a 990T for any organizations out there who don't already file one. It's a pretty easy addition to just file a Form 990T to get this credit. And so that's how you obtain the money. And it does require that you attach some additional forms to it. So it's a fairly simple filing, but it does include a Form 3800, and then there's applicable credits for each type of credit, or sorry, additional forms for each type of credit that you would also need to attach. And so I'll be honest, with our own very large software provider, we're still getting some updates here to help us make sure that we have the right forms eligible to attach for e-filing, because again, this is new for this filing season. So, and again, that 990T, just a reminder here, that has to be e-filed. You cannot just quickly, write a paper form up, find them online and print them and send them in. The IRS will not accept that. It has to be electronically filed. So a few items here to think of just as sample projects for things that, might be in your future, maybe you should consider being in your future because of these credits. Solar panels. So again, those have to be placed in service in 2023. It is open all the way for the next 10 years or so. So again, if you've ever thought about having that, if you have property that would make sense to do solar panels, and again, there's a lot of intricacies to some of these individual credits, but the panels would be eligible for both an investment credit up front and then potentially some production credits based on how much energy is produced and how it's used. There would be some additional credits available. And there's some specifics as to the size and how many panels you're putting in, and how many megawatts of energy it produces. So you can get pretty technical really quickly here, but something to certainly think about if that's ever been on your radar for something to do. The qualified commercial clean vehicle credit. So that one I've helped a couple of our clients file claims for. If your organization has ever considered, purchasing an electric vehicle, there's a lot more of them on the market now. You would be eligible for each vehicle to get a certain amount of credit. And again, depends upon what type of vehicle you're getting, and how much those credits are, but certainly worth looking into if that is ever part of your organization's plans. And then also, not the next one, but installing vehicle charging stations obviously maybe goes a little bit in connection with your organization using those. You might be able to get a credit for putting in charging stations that might be available for others to use as well. And then more generally, any type of new building you're looking to, new facility that you're building, any type of energy efficient work that you're putting into it, it's worth at least challenging to say, are we doing something here that might be eligible for these credits? So anytime you're starting to think about new buildings, things like that, keep this in the back of your mind. A couple of things with that: you can't use tax exempt grants to then also get this credit, or a forgivable loan, things like that. You aren't able to, kind of the same as Kelly was talking about, you don't get the same dollar twice, so no double dipping, which makes practical sense here. And then any type of geothermal or other large scale improvements to facilities. This is a little bit larger than just, maybe like an HVAC system upgrade, things like that. These are a little bit more, larger projects in the energy world. So again, keep these in mind. Some of these other credits do have a bonus to them if it is on tribal land or in like a low income community. So think about that also as potential for these credits. Okay, so that is the end of my presentation. I want to thank everyone else that was part of our presentation today. I think we have a couple of questions. I might cover one. I think some of the others did get covered in the rest of the presentation. So I think, Kelly, this one may be for you. And it
Real
was...
quick. Sorry, Jill. Can we go ahead and launch that last poll real quick? Just in...
Sorry, yes, absolutely.
Sure, 1 second.
And just a reminder, you do only need to answer 3 of the 4. So if you did miss that first one, this will cover you to get the CPE credit then. Okay, so then Kelly, I think there was one. We have just a minute, so I'm going to cover this, maybe ask this last one. And if we aren't able to answer it now, we can always follow up later. The question was, can the IRS audit the ERC refund at any time? And then secondly, if a uniform guidance audit, would there be a uniform guidance audit related to that piece? Which may be a Lauren or Jennifer question.
Yeah, I think I could handle the first part of that, but the second,
Yep.
maybe Lauren or Jennifer. So they have 3 years. That's when the statute would run out. However, I did recently see an article about a House bill that may extend that statute for 6 years. So I know a lot of people are thinking, okay, well, if I filed in 2021, and of course it's based on the date of when you filed your application, that I would be good in April 2025, which is, not that far away. But there is legislation out there that's trying to get passed through the government. And because this is such a hot topic right now, I could see the government trying to extend that statute of limitations because of the fraud implications that they've been seeing. And also the IRS, if they ever determine that there was fraud related to an application, that period of time does extend. So just putting that out there that technically it's 3 years, but it could be extended.
And in terms of it being subject to uniform guidance audit, no, we're not aware right now. It's not considered federal funding. It does not appear on anyone's scheduled expenditures of federal awards as federal dollars. That was similar to the PPP that was not subject to uniform guidance audit.
All right, thank you both for addressing that. And if we do have other questions that we didn't get to, we will follow up on those. So thank you, everybody. At the conclusion of this webinar, the short survey will launch, and you'll need to complete that evaluation for CPE credit. And then the certificates will be emailed after within 2 weeks. So don't hesitate to reach out to us for any questions or conversation. And thank you so much for your time today and for joining us, and have a great rest of your day.
Thank you.